Okay, happy Friday, everyone. Um, we are going to have a very interesting session today, and it might be your best session and it might be your worst session. Time will tell. Um, and the reason being is that um, just 2 seconds. So 20 years ago today, my father actually passed away.
Oh,
Uh,
oh,
I didn't, I must admit, I didn't expect it to hit me this hard. So I've been a bit of a wreck today, but anyway, um, to honor him, I think I should do why I'm here, and a lot has to do with him because if it wasn't for him, none of you would be here. And I'm sorry to be direct, but it's the truth. And so, sure. Um, anyway, so whew, it's this week we spoke about the why in the Wealth Going Global, and I don't know if you remember. And for those of you who weren't able to be here, I want to open it up for you quickly. Um, and it's ironically, I never planned it like this. It's mute whoever that is. Where's it gone now? My laptop decided to start again. So this week we went through this. If I share my screen with you quickly. And we started with the first module, which is the power of clarity. And it's all about understanding your why. And interestingly enough, I played for you this video here of Simon Sinek and how everyone is all about the how and the what. But actually the why is what sits at the center. And it's interesting because this diagram, whether you like it, whether it looks pretty or not, is really the essence of what I experienced with my own father. And and for some reason, rightly or wrongly, um, we had to experience that so that we could do what we're doing today. Um, and when I share things like this, then it's not a marketing brochure, because it truly, I think many of you know me now and know where it comes from. And if you look at my why and my invitation to all of you, whether you're doing Wealth Going Global or not, is to go and really, really explore your why. Like, why are you here? What is your purpose? I am truly, truly grateful. Very few people on the planet, well, I don't know how many to be honest, but not a lot that I know, can safely say they're living their purpose. And I am, and that's why, I mean, I cancelled every meeting today, except for this one. And it's because I know this is what I'm supposed to do. So, but you can see here, like, where this all comes from. And I hope that for all of you to do this exercise around your why, and yeah, hopefully it makes a little bit more sense to all of you. Anyway, are there any questions around the why? I think it's fairly self-explanatory. If you haven't watched the TED talk on Simon Sinek, Start with Why, it is so valuable in terms of that. But yeah. Okay, so are there any questions? Any comments, any conversations? Because what we're going to do today is I'm going to take you through the real estate section, which is the next module from the Investor Summit, and then we're going to break into groups and we can talk about our why. I know that certain people have reached out to me individually and said how powerful that session was in terms of discovering your why. By the way, I have shared this before, but I don't know if anyone wants this. You can just type in the chat box. I actually did this for something else. I did this for my I'm part of a men's group, and it's all about your ikigai and ultimately finding out like why you're here on this planet. And I hope for your sake, you know what you've heard of ikigai. But in simple terms, it's what you love, what the world needs, what you can be paid for, and what you're good at. And then you've got passion, mission, vocation, profession. But your ikigai is in the middle. So effectively, you do what you love and you get paid. And for me, these things all tie together with your why. And it's why this module, we literally start off with it, because I fundamentally believe it's the most important thing. And hopefully, at a deep level, I want you to discover your why. And equally, I am very consciously sharing my why, not only so that you can see how to do it in real life, but also so that if we're going on a journey and we're building trust, then you need to know why we're doing what we're doing. And I'll be frank with you. If I'd known how hard it was going to be to build a platform and to allow people all over the world to invest and like most entrepreneurs, you probably wouldn't have done it. But I don't regret ever doing it, because you know what we've done now. And I don't know, actually can't remember if I remember telling you this, but when I sat with Robert Kiyosaki and we were having lunch, and I had the opportunity, so I was telling him about Migrate, and I pulled out the laptop. Unfortunately, I don't have this on camera because I was there on my own. And like the moment he turned to talk to someone else, I tried to take a selfie, but it doesn't count. But I sat there and I actually showed him Migrate. And I said to him, I said, Robert, you know, what you did was democratize access to financial education. And what we've done is democratize access. Full stop. And, you know, so again, that's why the why is so important. And most people in finances are going, well, you know, Scott's all for the fairies. But I actually fundamentally believe if you get your why sorted, the rest of it will take care of itself. So that's a discussion enough from me about that. What I do want to go to is this one here. No, not that one. Where's it gone now? Yeah, this is it. Am I sharing my screen? No. Okay, so the one we're going to go through today is from Ken McElroy. So just do me a favor, type in the chat box if you've heard of Ken McElroy before. Has anyone heard of him before? So if you don't know who he is, Rich Dad Poor Dad has a thing called the Rich Dad Advisors. I don't know how many there are. There's about 7 or 8. And interestingly enough, the very first property book I ever read was this book here, which is Real Estate Riches. And this was written by Dr. Dolph DeRoos. And you can see it's part of the Rich Dad series, Rich Dad Advisors. Anyway, they fell out. I don't exactly know why. And then Ken McElroy became the real estate guy. And he does all of the investing for Robert Kiyosaki. So Robert owns about 10,000 apartments. And Ken not only helps acquire those, but manage all of them. And something that's quite interesting, a little bit off topic, but Robert says he was a C-class student and he hires A-class students. So Ken's the A-class student. And interestingly enough, this year, he set out to do $1 billion in investment. So that Warren Buffett thing, where be greedy when others are, be fearful when others are greedy, and greedy when others are fearful. While most people in America are nervous at the moment because of high interest rates, and we'll go into the details. Ken sees it as a massive opportunity. And like I've done with the other ones, let me try and give you the synopsis. In simple terms, there's going to be a lot of pain in the market. Specifically, when we're talking the market today, we talk about multifamily. So multifamily is where, you know, you and me, the mom and pop investor, go out and they buy one apartment. That's the old way of doing it. The new, you know, the institutional way of doing it is you buy the entire building. You own like 700 apartments. Now, it's a far better investment because if one tenant leaves, it doesn't matter. On top of that, you can reduce the cost dramatically because you can have one management agent who lives on the premises and can manage all the units. So you've got management, maintenance. It's much more scalable and much more efficient. By the way, it's what Gary Sachs is saying the same thing for London. So anyway, so that's what Ken McElroy specializes in. So when I'm talking real estate, I'm specifically talking the multifamily sector. And in multifamily, it's been the most, on a risk-adjusted return, it's been the most successful asset class since COVID in 2010. So it's, you know, a lot of institutional capital has gone in. In fact, property is very expensive now. So I don't know how much you understand what I'm talking about, but because there's so much demand, cap rates have compressed, which basically means properties got more expensive. And there's been more and more institutional capital coming in, which has basically pushed up prices. So you've got a triple storm that happened. That since COVID, prices went up dramatically. Secondly, people were borrowing very aggressively with loan to values which were out of sync and getting kind of cheap debt for 2-year financing. The problem is that 2 years is up, and that's why there's significant blood on the streets, which equally represents a big opportunity. So what is the synopsis? Well, the synopsis is there's going to be pain until 2027. So there was an oversupply because a lot of apartments were built during COVID, and a lot of them all came online at the same time. So you had an oversupply problem. You had interest rates going up, which meant that the maths didn't work anymore. And obviously, if there's an oversupply, you battle to rent out your apartments as well. So Ken McElroy's thesis, and I'm not trying to sound clever, that's the way they all talk. His thesis is that you need to buy now. So it's the old adage of buy off a desperate seller or a motivated seller, but be able to hold for 2 years. So from now until 2027, because it's going to be tough for the rest of this year and for 2026. But then by 2027, there's virtually no new construction happening at the moment. So demand is increasing and the supply will be absorbed. And if you're buying now, you'll be ahead of the curve in 2027, and you're buying it at discounted rates today because you've got motivated sellers, be it the bank, because sometimes the bank has repossessed a property, and or just a seller that is underwater basically in terms of the process. So that's basically the synopsis. Let's take a look at the detail here in terms of what I'm going to share with you. So navigating the squeeze, how tariffs, taxes, inflation, and supply shortages are reshaping real estate. Sorry, I think I said to you, he was aiming to do $1 billion in 2025, and he's done 500 million so far. So in the first 6 months of this year, he's done $500 million worth of acquisitions. In this boots on the ground session, veteran real estate investor McElroy connects today's inflationary environment with structural issues like tariffs, taxes, rising interest rates, and a growing crisis of supply. He explains why US housing is facing a perfect storm of reduced affordability as in interest rates have gone up and shrinking home ownership, with millions priced out of the ownership forced into rental markets. McElroy walks investors through how to adapt, where to look, what to avoid, and how to build resilience into every property deal moving forward. By the way, what I'm going to share with you today is probably the single most important lesson I can teach you about American property, and to be fair, property in general, which is that property is all about the fundamentals. You've got to know what the fundamentals are. And if you buy with strong fundamentals, you're going to make money long term. And if you buy with weak fundamentals, you're going to lose money. So some of the key takeaways. The US has a major housing shortage. Demand far exceeds supply, and new development is not keeping up with costs, regulation, and NIMBYism. So, NIMBYism. Does anyone know what that is? Type in the chat box for me if you know what that is. Americans love their acronyms. Okay, I don't know exactly what it stands for. I'm sure someone can chat GPT it, but it's basically people living in smaller houses, fragmented families, all of that type of stuff. There's basically more people that need more houses. So like, yeah, like you used to have one family in one house, and now you got people living in different houses. Let's just Google it. I don't know what the acronym actually stands for exactly, but let's just do it quickly.
Not in my backyard.
Describes the opposition. Oh, okay, so I was completely wrong. It's not. It's basically all the greenies that don't allow anything to be built. Okay, I didn't know that. Interesting. Okay, home ownership rates are falling, so I'm going to talk a lot about this. Younger generations are being locked out due to high prices, interest rates, and stagnant wages. Tariffs, inflation are crippling builders. So cost overruns are killing projects before they begin, worsening the supply issue. Taxes are quietly creeping in. Governments are introducing vacancy taxes, audit pressures, and investor surcharges to raise revenue. Rents will keep rising. With ownership out of reach for many, rental demand is skyrocketing, especially in affordable housing. Interest rates have paralyzed the market. Sellers won't drop prices. Buyers can't justify high debt, so transactions stall. And investors must pivot from growth to resilience. Survival now depends on cash flow, not speculation. So again, there's over and over again this focus on cash flow. Action points for investors: invest where supply is constrained. So markets with strict zoning, limited permits, and rising population. So right back to, I don't know how many of you do or don't know the story, but I went to America back in 2010 to try and buy property. I was there for 5 weeks, and I couldn't find anyone on the ground I could trust. It really was a shit show. I kind of felt like they were going to sell me their sister if I sold a house or bought a house. So when we went back in 2012, we did it differently. We started in San Diego, and we ran right across to the East Coast in Orlando and New York. And we stopped in 8 different cities over 9 days. And all we were trying to do was find partners on the ground that we could trust. And that was the holiday or the trip that I learned about the fundamentals of American property. So there's a couple of things here. One is that you've got blue states and red states. So a blue state is a democratic state. It's generally tenant friendly, lots of rules. California is a classic example. New York's a classic example. Lots of rules, lots of taxes, etc., and very expensive. The red states tend to be the republic states. They are landlord friendly. They're much more capitalistic. They generally are very pro-business. And so there's always big population moving into those places. So places like Florida, Atlanta, Texas, where people are moving in because they can get jobs. And America is very transient. People move based on where they can get jobs. And obviously, if people are getting jobs and the population is rising, then it's that tide rises all boats. So it is, so important. And the opposite of this was Detroit, where 25% of Detroit is shut down. I don't know if that's still the case, but this was 10 plus years ago. So 25% of the city is shut down. Now, Detroit as a car manufacturing place is falling to pieces. And people were trying to buy houses there, or were being sold houses there at a massive discount. But a discount is not a discount if it never comes back. Yes, Richard, redneck country. That's it. Look, to be honest, in a place called North Dakota, they call it the red, white, and blue state. Now, it's not politically correct, but it's rednecks, whites only, and blue collar workers. America's a crazy place. But the point being is that you've got to be in states, and specifically cities, where there's more demand than there is supply. And it was really interesting because he took us through the market and where to look and which markets they're focusing on. You need to target renters by necessity. So workforce and middle income tenants are future demand. So this kind of that socioeconomic class that can't afford to buy a house, And so they're kind of the permanent workforce and permanent tenants. Prepare for regulatory friction, so expect new local restrictions, tax pressure, and tenant-friendly laws. Underwrite conservatively, so assume rising costs, flat valuations, and limited exit liquidity. So that's where you're basically doing the business model on a deal. Know your numbers. Inflation, interest rates, and cap rates can quickly turn a good deal into a bad one. And diversify away from heavy regulated markets. Focus on states and cities with landlord-friendly policies. So again, California very, very high in rules and in taxes. And you compare that to Texas, and it's like chalk and cheese. Okay, let's look at the overall thing. So basically, he spoke about the deepening US housing shortage. We're 5 to 7 million homes short, referencing multiple national studies. The issue isn't just demand, it's the lack of supply. Tariff, zoning restriction, labor shortages, and material inflation all have new construction, making construction slower and more expensive. I found this really interesting. So there's a downward trend in home ownership. So apparently under like Ronald Reagan, it got just below 70%, 68 or 69% of all Americans actually owned a house. And what he was basically saying is that people under 40 just can't afford to buy anymore because of the higher interest rates, tighter credit, surging house prices, etc. And so the rental pool is growing faster and faster. But what's really interesting, and I want to find you the exact stat here, I don't know if it's going to come up later, but I want to find you the exact stat, is that he's expecting, so home ownership's gone from 68, 69% to 65%. And every 1% that drops is another million people that are coming into the market as tenants. And he's expecting that it should drop below 60%. And it's never been below 62. And the average age to buy a house now is 15 years later than what it used to be. So there's a fundamental shift that is happening, which is reshaping the whole property market. They call it the retail market. And so where the opportunity lies is these entry-level homes are now becoming short-term rentals. As ownership declines, rents go up because landlords, it's not that they're greedy, it's because there's just not enough demand and not enough supply. Then this rising tariffs, well, that's impacted building costs. I'm paying 40% more for lumber than I was 3 years ago. Steel, concrete, and appliances have all jumped, making basic renovations financially tighter. Developers are shelving projects because the pro forma no longer works. So McElroy warned investors to be cautious of government responses, rent control, vacancy taxes, and property audits. He advised investors to focus on properties in regions of net inbound migration, strong job growth, and fewer political barriers to development. And I'll go through some of those areas now with you. Okay, I found this one really interesting. So this is the fundamentals that I'm referring to. And he said, these are the 3 must-haves. By the way, this is quite a good property lesson, full stop, anywhere in the world. So I learned this originally from Dr. Dolph DeRoos, funny enough, around net population. I remember learning it from Dolph. You know, most people probably don't know this, but the Japanese property market peaked in about 1988, and it then crashed and it's never recovered. But what people don't realize is that the Japanese population went from 120 million to 100 million. And so their supply and demand is out of kilter. And that's why it hasn't recovered and will never recover. So in terms of net migration, Ken only wants to invest in areas where people are constantly moving in, not out. Jobs follow people and real estate follow jobs. He explained markets with population growth signal rising demand, economic expansion, and rental stability. He avoids regions experiencing population decline or stagnation, regardless of short-term pricing. So again, I just like to use Detroit because most people know that. But you know, when a city's on the decline, like it's, you might get good discounts, but you're not going to win long term. The next one, and by the way, this is all economic data you can get. Job growth and economic drivers. Strong job markets are the backbone of real estate success. Ken looks for cities or metros with diversified employment base, not reliant on a single industry. Tech, healthcare, logistics, education are particularly attractive. So like Texas is, you know, ticks this big time. Atlanta, most people don't know this, but the southeast of America, which is Atlanta, Florida, that area, is the fourth biggest economy in the world, just that on its own. And Atlanta as a city is one of the biggest cities in America, and it's got a massive diverse base. The likes of Coca-Cola are based there, and you know, I could go on and on and on about all the big companies that are based there. Austin, Texas has become the new tech hub away from Silicon Valley, as an example. If a city is adding employers, it's adding tenants, and that's good for business. So what happened during COVID is a lot of the big tech companies moved to Austin because it was cheaper and because of lifestyle. And so property went through the roof in Austin. To my knowledge, it actually doubled. And it's now come back. It's just dropped by about 15%. And then landlord-friendly policies. No deal makes sense in a place that won't let you manage your investment effectively, London. By the way, my tenant is refusing to leave in London. If she doesn't leave by next Thursday, I'm flying to London. Ken avoids jurisdiction with aggressive rent control, overregulation, or hostile landlord legislation. I don't want to fight with the government to run my property. So the three pillars are people, productivity, and policy. It's pretty cool thing, eh? In terms of like a good learning, you might want to screenshot that or whatever. If a market doesn't meet all three, Ken walks away, no matter how tempting the numbers look on the surface. Then Ken's three non-negotiables before he invests. Ken made it clear, in an inflationary environment, inflationary, uncertain environment, every real estate deal he considers must deliver on his three core financial benefits, or it's a no. These are not preferences, they are non-negotiables, designed to preserve and grow wealth in any cycle. So the first one is inflation hedge. The asset must protect against inflation by appreciating in value or generating higher income as prices rise. Real estate gives you leverage over inflation. Your debt stays fixed while the rents and values rise. Ken seeks properties in high demand areas where scarcity drives up replacement costs and rents over time. So the first one is all about inflation. The second one is cash flow. The investment must generate positive monthly cash flow from day one, not just potential gains. Cash flow is what lets you sleep at night. Appreciation is a bonus. McElroy stressed that appreciation is speculative, but cash flow is real, and it's what makes an asset sustainable over time. Now, any of you that have done the challenge will know that I talk a lot about this. And one of the things that I learned over time was the middle class and professionals chase capital growth. So if you go to the pub tonight and you talk to your mates, they'll be talking about the latest share they bought that's gone up. They'll be talking about Bitcoin and the fact it's gone up. They'll be talking about their house and the fact that, you know, they bought their house for this and it's gone up by this. But if you go sit at a wealthy table, they don't ever talk about capital growth. All they talk about is income. There we are, Richard, well done. The rich invest for income. And it's so interesting because I teach people this all the time, but it's so weird to sit and have someone, you know, who's doing a lot more property than me to pretty much say it's like non-negotiable. And then finally, tax advantages. Every deal must provide tax-efficient income or write-offs to reduce taxable liabilities. Ken uses strategies like depreciation, cost segregation, 1031 exchanges, and bonus depreciation where applicable. Taxes are your biggest expense. Real estate is one of the last legal shelters left. Now, one of my big takeaways from this entire event was, I went and sat in 1031. I don't know if you know what a 1031 is, but basically if I have a house or any building for that matter, and I sell it, and within 45 days, I take that money and I buy something else, then I don't pay capital gains tax in America. Like effectively the capital gains tax gets deferred into the next asset. So as long as you buy something within 45 days, you technically never pay capital gains tax. And one of my big takeaways was that we as investors are not using tax advantages enough. I did tell you that there's new tax laws coming out now, literally like it should be happening now because they said about a month from when I was there. So it was literally happening right now. And I actually asked about how does one, because effectively we're coming in, the word they would use is a limited partnership model or a syndication. And I asked about how you can actually do that. And there are ways to do it. So I'm actually exploring that with the accountants, our accountants on our side, but also with their accountants as to how we can be more tax efficient in terms of our investments. These three factors, inflation protection, immediate cash flow, and tax efficiency, are the backbone of Ken's wealth strategy. If a deal doesn't meet all three, he walks away. no matter how trendy the market or attractive the brochure. And then final thought, we don't have a housing bubble, we have a housing bottleneck. With ownership falling, supply shrinking, and cost climbing, the future of real estate belongs to those who adapt. Focus on cash flow, essential housing, and long-term demand drivers. And you'll not only survive the squeeze, you'll thrive on the other side of it. Okay, so any comments or thoughts? Let me go to my notes here. We can see if there's any other little gems that I haven't put in here yet. Okay, I just want to check. What are you guys? Oh, no, you're not seeing it. Hang on 2 seconds. I was trying to share my iPad with you. Okay, perfect. So, right. So he's done 7 transactions this year. And the average size was between 25 million to 97 million. And like I told you, he's done over 500 million already this year. The most important thing is affordability and availability. And this, so that's within a city. So he calls that the first layer. So how affordable and available are the opportunities? And then the second layer is there an oversupply in the city? The fundamentals are that America has 4.3 million units short. They need 1.6 million homes a year to service the current population growth. Just something that's really important. This didn't come up from Ken McElroy, but it came up from another guy called Keith Weinhold. Interestingly enough, which I didn't know, from 1945, it's sorry, not 1945, 2045, the American population is expected to start declining. So all of these things are good for the next 20 years, but in 2045, the population is expected to decline unless they do something to really open up immigration. Peak supply was in 2006. So that's when the most new buildings came on, the most new apartments or houses came on the market. And then, as you know, 2 or 3 years later, they had a crash and 10 million and then went into foreclosure. Real estate does not do well without people. It's quite a cool saying. It's so simple, but so true. There's an undersupply of housing. I told you this one already, 65% of home ownership, 1 million people for every % down. It could go below 60. It's never been below 62. It's currently 65. And the average age is buying houses 15 years later now. So in Texas, Austin has been the top city in the country. I already told you why, because all the tech jobs moved there. More people are coming in than going out. Florida is in a bubble and it's popping. Austin, because of the tech, the price has doubled, but it's now changing. And I don't know if it was in this talk or another one, but apparently Austin's come down about 15%. Inflation in June 2022 was 9.2%. I must admit, I personally don't remember ever reading that it got that high. So that's quite interesting to me. And supply is down like we discussed. So why is he investing now? Because many people would say, well, why don't you just wait? Well, the answer is that in places like Phoenix, there's cities where they're literally giving away 4 months free rent up front. So that's, again, you've got an oversupply, they're battling to get tenants. And when landlords are like this, if you've got a big wallet and you can buy aggressively, you can actually get really good deals as long as you can hold till 2027, which is, I've already told you this, because that's when they're expecting rents to go up. So you've got to build a business model that can be resilient for the next 2 years. You want to buy below replacement costs. And if you're doing that, you don't mind a 2-year disruption. Ken's 3 things, which we've discussed: inflation, cash flow today, hope is not a strategy, and then tax laws. And then predictions, over 60% of the country is below. So this is quite interesting. So although interest rates have gone up, over 60% of the country, people that own houses or apartments, actually fix their interest rates below 4%. And in America, you can fix your interest rates for 30 years. So even though interest rates have gone up, more than 60% are not affected. The professional investors are coming back into the market now. Multifamily will have a very bad year in 2026. So it's really interesting when you've got someone that's investing $1 billion this year and he's telling you that next year is going to be a very bad year. Interesting mindset, huh? Aim to do 1 billion, done 500. I told you that part. And that's the notes. So that is everything from Ken. I do want to remind you, let's just go back to those fundamentals, and then we're going to break into a room for 10 minutes. Okay, so let's just look back. Let's just go back over what we said here, because there's major lessons here. Okay, so you've got you can read all this, you can have access to all of this stuff. But the big lesson here is this, because this is like an entire property course just on its own. So these are the three things: net migration, job growth, and landlord-friendly states. By the way, when we do countries, which is next Tuesday, we're going to go into this in more detail. And then the other part, inflation hedge, cash flow, and tax advantages. So three very simple and very clear rules around property. Okay, any questions before we pivot into the room? So what my homework is for the room is I'm going to split us up. We've got about 38 people here. So I'm going to split us up into groups of 3. And my request is that you each take a turn. So take 2 or 3 minutes each, which we've got 10 minutes. Everyone should have 2 or 3 minutes. And just talk through your why, what it was like for you as an experience. And then also around what we've just discussed with this property. Because what I've just given you is like property 101. Like I've literally just taught you the most important principles to investing in property, whether it's a house or whether it's 500 apartments, it's the exact same principle. And so are you clear on what we want to do basically? What do they see about 2027? So what's happening there, Shemin, is that the demand continues to rise and supply is constrained. There's no more new supply coming into the market. So the expectation is that until 2027, you're effectively below the curve. But after 2027, you go through the curve where there again will be more demand than there is supply. And when there's more demand than there's supply, then they expect rentals to go up. And when rentals go up, prices go up. So the inflection point is 2027. Is this document in the school classroom? It is, Safina, but I will share it here just so that everyone's got it as well. So I'm going to put it in the chat room now for everyone. And yeah, I'd love some comments, valuable, not valuable. Am I on my high horse, my little emotional journey today in my own little world? Is this of value to you? Yes, no. So let me share this quickly. No, that's not what I was looking for. I'm just getting you that document so that you got it. Okay, there are. It's in the chat room for everyone. Okay, I'm going to break out now. So what have we got? 35 people. So I will do 12 rooms. No, wait, I'll do 11 rooms. So 10 odd minutes. I think it's very valuable to have a conversation with your peers about what you learned, and I'll see you back in about 10 minutes. Please just click on you'll see a button comes up and it just goes accept. And you can go jump into the room. Okay, who have we still got? Richard, Fiona, you guys got your links? Rom, do you need a room? Hey, how was that? Let's get everyone back. All right, hold on, 5 seconds. Yeah, I think we should have everyone back here. Okay, welcome all back. So let me just answer Glenn's question, because I think it's a good question. I only saw it now after we just going to mute everyone. You can unmute yourself if you want to. Okay, so Glenn basically said, yeah, Scott, knowing what you know about the US market from what you just taught us, are you going to be looking for more properties to put on the Wealth Migrate platform? Completely. But in certain sectors and in certain areas. So for the mastermind members, not next week, the week after, we've got a guy coming to teach us about self-storage. I just messaged Hannah Hammond again today to say, hey, what's happening with my data centers? Multifamily, there's good opportunity in multifamily if you've got the right partners, and they know what they're doing. And next week, let me just show you here quickly. So next week, we are going to be doing this one here, which is really, really interesting, which I think is going to answer your question, Glenn, and everyone else's. So this is the session for next week, which is navigating the commercial real estate playbook. So this was done by Hannah Hammond. And the thing that I found most interesting here is there's $1 trillion coming due in 2025. $1 trillion, that's a hell of a lot of money. And 25% of it is underwater. There we are. Okay. So basically there's a lot of pain, but there's also a lot of opportunity. So yeah, let's look at this very quickly. I'm not going to go through this because it's next week, but you can literally see I'm going to go through every sector and what you need to look at, and whether it's good or it's bad. So we're literally going to do that next week. But yes, Glenn, the one thing about America, you must always be very careful with America. There is no American market. Like if you say it's going up in Phoenix, it could be plummeting in Florida. Obviously there's trends, but I don't know if you've heard me say this before, but there are 300 MSAs. So in terms of how you look at property, an MSA is known as a metropolitan statistical area. Effectively, it's a city. There are 300 MSAs in America. 300. Like in England, I don't know how many there are in England, but it can't be more than 10 or 15, to put in perspective. And in Australia, it's probably not even 10. So if you're wanting to, be a big investor in Australia, like there's not that many cities to invest in. In America, there's 300. So, never ever get confused when someone says, oh, the market's crashing. I mean, obviously in 2008, the whole bloody market crashed. But even then, I guarantee you that there were areas like Vegas that lost 70%. So Las Vegas lost 70%. Okay, so just put that in perspective. You own $1 million house, and it's now worth $300,000, and you still owe the bank $700,000. That's not a nice situation to be in. No wonder they called it jingle mail, because basically when the mail arrived and with the postman, it jingled because everyone was sending their keys back, basically, in simple terms. But it doesn't mean the whole of America was like that. There were other areas that weren't like that. So Glenn, I don't know if I'm answering your question, but if I've learned one thing in my life, where there's problems, there's opportunity. And when most other people are running away, that's when you need to be running in, which is the whole psychology. But it all comes down to having the right partners. So I wouldn't go and buy multifamily myself. Not a chance. I would go and find a partner that buys multifamily. By the way, Ken McElroy is one of the ones that I'm lining up to try and partner with. So I don't know about you, but if I was going to do it, I'd love to partner with someone like him. Does that make sense?
Perfect sense, Scott. Thank you very much for your very in-depth answer.
Cool. I mean, I always say, like, what he knows about multifamily, the rest of us could study for the next 20 years and we wouldn't have enough knowledge. And on top of that, none of us have access to data like he has access to data. So, why compete with him? Why not just join him? Like, that's my attitude with it. Okay, any takeaways? I know we're coming up to the hour. Any takeaways from your vibrant session? What happened? Did you enjoy it? Is it good? Do you enjoy these breakaway sessions? Otherwise, it's just me talking the whole time, this is supposed to be a Q&A, not a Scott monologue.
I just want to say just one thing. I broke away with three tremendous ladies, and every single one of them had the same views when going through the wealth plan. It's uncanny that we are all on the same page. How we want financial freedom, how we want to help others. So yeah, just a shout out to the three ladies that I spoke to. Kelly was one of them. Fantastic. So yeah, well worth it.
Awesome. Any other takeaways? You can say them, type them. Anyone else have any key takeaways that'd be valuable for everyone? Thank you, Glenn, for sharing. I appreciate it a lot. And just by the way,
Scott,
Scott,
yeah, I just want to add that one of the team members actually shared that, firstly, London is very expensive, as you've expressed. And the fact that if you pensioners, right, and if you're on the Wealth Migrate platform, you know what, it's very difficult to make a decision when you pensioners. What's your best approach on that? And I've shared my insight that, you know what, it needs to be discussed with the family. Do you have any view on that?
No, look, I don't know if I fully understand the question, but I'm assuming that by pensioner, everyone's got different needs. So I'm assuming there's obviously certain needs for someone when they're on pension, like income. And my view on it would be that you always, I mean, that's why I always start with why. Like, why do you need this? And then what is the plan? And then does the asset fit the plan? So most people have it the wrong way around. They like go and look at a property and they say, hey, should I buy this property? Is it good or bad? But what they don't understand is you need the plan first, and then the asset is purely a vehicle on the plan.
Sure. Thanks, Scott.
I don't know if I answered your question. I don't know if I fully understood it. So,
well, basically what I'm saying is if you're a pensioner and you wish to make an investment, now, do you go abroad and make the investment, or do you remain local and just deal with what you've got and not look at overseas type property investment? That's the question.
Again, I learned this off Hannes Dreyer 25 years ago. It depends, because you should compare an apple with an apple. So if you've got a local investment that's getting you a 25% return, and you've got an overseas investment that's getting you a 2% return, I don't care what currency you're talking in, you should probably do the local investment. But if you've got a local investment and you've got a South African accent, so I'm assuming it's local in an 8-9% return in rands, where the rand is devaluing by statistically 5% a year for 40 years against the dollar. If you're getting a 15% return in dollars and you're getting a 9-10% return in rand, you are 10% underwater. You're 10%, and inflation's worse in South Africa. So if you take that into account, you could be somewhere between 10 to 15% different. And over 1 year, that won't make a big difference. But over 10 years, that's the difference between, I don't know, some of you have seen my calculation where I say, if you've got $12,000, and I did the calculation, the guy had his money in Allan Gray, and he was getting 7% in Allan Gray in rand. And I showed him that statistically, our family office and ourselves have got 14% for the last decade in dollars. And I showed him the difference. And the difference over 30 years equated to $742,000.
True. No, sure. I just gave my piece, but yeah, it's good to get it from you as well. So yeah.
Look, thanks. I think what's interesting is what is local anymore. I mean, 10 years ago, all the English people were like, yay, we live in England and our houses are wonderful and yours in South Africa are shit. Well, now I got a sitting tenant and my estate agent's too scared to do anything. And I'm sorry for the English, but I'm going to the yellow belliness and the scared of the system. And my mate who I own the house was phoning me today and goes, what happens if she's got anxiety and she could sue us for anxiety? I'm like, I'm sorry, but like this, you don't even want to get me on my work thing. Like, I'm like, we have a contract. You haven't signed. We signed the agreement. I've abided by my side of the contract. You want to see anxiety and stress? You haven't met Scott Picken yet. Any of you that live in London on the 16th of August, we are holding the biggest street party in the history of Wimbledon. It's at my house. Okay. Everyone, and bring 10 friends. I'll pay for all the drinks, the food, bring music. I'm going to make such a menace of myself. You've got no idea. So anyway,
I'll be up for that, Scott. Just letting you know.
Yeah, well, the point is too, the problem, the English are used to playing by the rules. I come from a cowboy country, and if you want to play like a cowboy, I'm a perfect cowboy. So, you know what I mean? So I probably shouldn't be saying this publicly, but yeah, I'll play fair until you don't play fair. But if we want to play dirty, then we can both play dirty. You know? So anyway, that probably should be there.
I like the spirit.
Into my rant publicly.
Yeah, I like the spirit. About time somebody stands up to all this stupidness.
Absolutely bloody ridiculous. She's got anxiety because she has to move out. And what do you think? We don't have anxiety because we're about to lose the whole bloody house sale. It's ridiculous. You know what I mean? So anyway, I don't know how I got onto that. But I do know how, because Chiba asked if you've got local property. Well, I think if you've got local English property, you better bloody sell it quickly, because the rules are changing in the first quarter of next year and they're getting even worse. So back to my point, and just for the record, I don't know why I'm telling you guys all of this, but you're the first to hear this. I'm going to reach out to Gary Sachs, and I'm going to try and get him involved so we can make a whole social media campaign around this. And then we can say, do you want to keep investing like a mom and pop, or do you want to do it properly in the institutional way? And we launch that London development at the same time. That's my bigger picture plan, if I can get it right.
Well, it sounds exciting, Scott.
Yeah. Well, what do they say? Turn lemons into lemonade.
Okay.
So anyway, that's probably enough ranting and raving from me. I'm probably going to say something I'm going to get into trouble for. Kelly, this is the moment as a lawyer where you're like, Scott, shut up. But anyway, yeah. So I just want to say thank you to all of you. I wouldn't be here if I didn't want to be here. It's always an honor and a privilege. My Friday afternoon, this session is my favorite of the whole week. It probably should say quite a lot to you that I had meetings all day with the likes of Garth Wellman, Steve Streetman in America, all about blockchain, et cetera, et cetera, et cetera. And I actually postponed everything, but I'm here today. So we'll see you next week.
Thanks, Scott. Appreciate it. Appreciate your passion.
Yeah, I know. I'm off to get my son, watch a bit of rugby, and then I'm going on the boat to throw roses for my dad.
Yes.
There's a one.
Thank you.